Have you ever opened your phone, seen a headline about some conflict thousands of miles away, and then wondered, wait, why did my stock portfolio just take a hit? Well, today we're going to connect those dots. We're going to trace the exact path from a flashpoint in the Middle East right to the heart of the Indian market. It's a story about global shockwaves and how they have a very personal, very local impact. It's a really good question, right? It can feel totally random. How can events happening on the other side of the planet make your investments tremble? The answer, it turns out, is a chain reaction. And it all starts with one single critical domino. So our story kicks off with a geopolitical powder keg. You have tensions between the United States, Israel, and Iran just boiling over. And that friction causes an immediate and really severe disruption in one of the world's most vital shipping lanes. And this right here, this gets to the absolute heart of the problem. You see, the Strait of Hormuz isn't just a body of water. Think of it more like the jugular vein for global energy. A full 20% of the world's oil flows through there. So when you squeeze it, the very first thing that happens is a spike in the price of crude oil. Okay, so let's follow the money because this is exactly where a distant crisis lands right on India's doorstep. As a major oil importer, any disruption like this immediately adds what traders call a war premium to every single barrel of oil we buy. $88, that was the new price for a barrel of Brent crude on March 6th. Now, that's a number that sends alarm bells screaming through finance ministries and trading floors all over the world, but maybe nowhere louder than right here in New Delhi. And this chart, wow, it really puts that number into perspective. We're not talking about some minor price wiggle here. This is a sudden, sharp jolt from where things were before the conflict. It's what economists call a supply-side shock, and it's the kind of thing that sends immediate, unfiltered panic right through the financial markets. And yeah, spooked is probably an understatement. When oil prices surge like that, big money investors, they go into self-preservation mode. They start pulling their capital away from anything they see as risky. And in a global crisis, emerging markets like India, unfortunately, often get labeled as high risk. And you don't have to take my word for it. This quote from Morgan Stanley perfectly captures the thinking inside the world's biggest financial institutions. They're basically saying, all right, time to play defense. They saw the writing on the wall for supply chain chaos and decided, you know what? We're pulling our money out before things get any worse. And this is what that pullback looks like in cold, hard cash. Over 21,000 crore rupees. That's how much foreign institutional investors, the FIIs, dumped from Indian stocks in just 1 month. It's a massive, massive capital exodus, fueled entirely by global fear. Now this number here, think of it like the market's heart rate, and it is soaring. The India VIX, which is often called the fear gauge, jumped by over 11%. A higher VIX basically means traders are betting on wild price swings in the near future. And that is a crystal clear sign of rising panic and sell-offs. So, what's the result of billions of rupees flooding out of the market and panic levels shooting through the roof? Well, you get what you see here, a sea of red on the trading screens. Let's look at the specific damage this did to India's key stock market indices. The BSE Sensex got absolutely hammered. It plunged nearly 1,100 points in a single day. Now, to put that in perspective, that's a drop of about 1.5%. It literally wiped out weeks of gains in just a few hours, and seriously shook investor confidence. And the Nifty 50 wasn't spared either. It dropped over 300 points, falling below that psychologically important 24,500 mark. This shows the sell-off wasn't just isolated to a few sectors. It hit the biggest and most stable companies in the country. And the really crucial takeaway here is that this wasn't just one bad Friday. The combined impact of all these losses led to the sharpest weekly drop the market had seen in over a year. This was a clear signal that the whole mood, the entire sentiment among investors, had turned sour. But, and this is important, here's where the story gets a little more nuanced. Because amidst all of that red, there were actually pockets of green. See, not everyone was selling. In a crisis, smart money doesn't just run away. It repositions. It seeks safety, or sometimes it even finds unique opportunities. This table is fascinating because it really reveals the strategic chess moves that investors were making. I mean, look at Reliance. It actually gained because a US waiver meant it could get access to cheaper Russian oil. Then you have Bharat Electronics, a defense firm, which rose as a classic geopolitical hedge. Investors were betting that more conflict would actually be good for their business. And then on the flip side, you see banks and industrial companies falling hard because of fears about how expensive oil would slow down the entire economy.
But the impact, it wasn't just contained to the stock market. Not at all. These shockwaves rippled out, and they started affecting the broader Indian economy in some really critical ways.
The Indian rupee found itself caught in a vice grip. I mean, just think about it for a second. Suddenly, India needed way more US dollars to pay for that expensive oil. But at the exact same time, you had all those foreign investors selling off their rupees to get their dollars out of the country. This double whammy put immense downward pressure on our currency. And this is the bigger, longer-term threat. See, sustained high oil prices don't just stay at the petrol pump. They bleed into the cost of everything: transportation, manufacturing, pushing up inflation across the board. This can cost the economy billions, it can worsen our trade balance, and it puts the Reserve Bank of India in a very, very tough spot when it comes to managing interest rates. But India is not defenseless. This massive number represents the country's foreign exchange reserves, which luckily were at an all-time high. Think of this as India's financial shield. It gives the central bank the firepower it needs to step into the market and support the rupee, preventing a complete collapse.
So let's just quickly trace that domino effect one more time. Step 1. A geopolitical crisis in the Middle East messes with oil supplies. Step 2. That makes oil prices spike, which creates fear. Step 3. That fear causes foreign investors to pull billions out of India. And Step 4. That capital flight tanks the stock market and weakens the rupee. A perfect storm playing out in real time.
Which, brings us to this final, really crucial question. This entire event is such a stark reminder of just how interconnected our world has become. It proves that in today's economy, geographic distance is absolutely no shield from financial shockwaves. If this explainer helped you make a little more sense of the complex forces moving the market, do us a favor and hit that like button. And, of course, subscribe for more deep dives that connect the big headlines to your wallet. And now, we want to hear from you. What economic mystery should we unravel next? Drop your ideas for us in the comments below. Thanks so much for watching.